Hi, and welcome to Boom It's on the Blockchain. We have got our 58th show, and we've got a special guest for us today, Emmanuel Daniel. How are you, Emmanuel?
Great to see you, Alistair, and can't wait to get into our conversation.
Yeah, we were just speaking a little bit offline about everything. We should have kept it on the show, guys. It was getting good.
Yeah.
So Emmanuel, just give a bit of background about yourself. You've just recently published a book, and let our viewers know all about you.
Well, the first question you asked me offline just now was, where am I now? I'm actually in New York, and I divide my time between New York, Singapore, which is where I'm originally from, and Beijing, where I have a pretty good business going with the banking system in China. I'm the founder of something called The Asian Banker. I founded it in 1996. I started it as a publication, but today it's not a publication, it's a platform. We sell lots of research. We help banks benchmark their operations and stuff. And we are active in just about every developed Asian country and now in the Middle East and Africa. So it's been an incredible journey, being able to get off a plane in any country and know the chairman or the CEOs of the major banks in just about every developed, more developed Asian countries, and then also, of course, in the US, because as you'll see, that the person who wrote my books forward, the two people, Barney Frank, who wrote the Dodd-Frank Act, and Richard Sandor, a leader in the market space, creator of the derivatives exchange. So how I came on to the US was basically American bankers, with interest in outside of the US. And I was like the linchpin, sort of making relationships happen. And over a 7-year period, I've been able to understand a lot about how commercial banks work. And then this whole decentralized finance universe started creeping in on me. And I wanted to capture all of that in a book. And so I wrote this book, The Great Transition, the personalization of finance is here. And the interesting thing about writing this book was that the first person it had to change was me, because I understood all the DNA of commercial banking, traditional banking, and I wanted to see how much of that was going to get carried into cryptos and decentralized finance in general. And I think I understand the concerns of traditional bankers and traditional finance people who look at all the developments taking place in the crypto world, in decentralized world, and thinking that how much of that is real. I say today, because I meet them, I talk with them, I attend their meetings, I see the applications that they develop, and I say that the network world is definitely on its way, and that the transition is what we're dealing with right at the moment, and that's why the title of the book, The Great Transition. But I also then make some very important assertions, and I was actually a little bit concerned that that I had to speak louder than everybody else to get heard on this, and that is that I'm saying that in technology terms, we are now transitioning from the platform era to personalization. So the days of the platform era are over, and I'm saying this at a time when the platform era is actually at the height of it. Meaning that the social media platforms, the trading platforms, anyone who wants to start a digital bank thinks of things in platform terms, and I'm saying that the user is gaining a lot more control over his data, his assets, and who he wants to interact with, and anyone who thinks platforms as a way of onboarding as many users as possible and then monetizing them has to start thinking differently today. And then I give examples in there about how the original platform players didn't make the transition from desktop to mobile, and then now it's from mobile to device independence, Internet of Things, and stuff like that. So I'm talking a little bit about technology, but I'm looking at it in the way that technology affects the future of finance. In that way. And in writing this book, I also came to terms with the fact that the world in which we are living in is changing. And one of the reasons I'm spending a lot more time in the U.S. Is that with personalization, you find that society itself is increasingly difficult to govern. So I go into a little bit of that, and because I took a holistic approach in the way I wrote my book. I answered questions like, will the dollar be the dominant currency going forward? And for all of these questions, I go back to first principles. What was it that created the financial system that we know today, and then use those first principles to extrapolate and say, what the future will look like, and who the dominant players will look like going forward.
Yeah, that's super interesting. We've actually been, I'll bring it up just now, central bank digital currencies. So, I've been studying this over the last 3 weeks, actually. It was a bit more in terms of, because the Fed put out the white paper for the digital dollar. So, and that wasn't even that long ago, but I was just reading about digital yen and what's happening with China. And essentially I've been reading, I follow like Cointelegraph and CoinDesk and these sort of, publications, but they're talking about, the Chinese using their central bank digital currency as a mechanism to bypass the US dollar as the most premium currency in the world. Is this just sort of hogwash, or what are your thoughts on it all, and how's that going to all play out? Because, that's a major concern, especially to Americans, because fiat currency is obviously the number one reserve currency in the world right now.
Well, there are two questions in what you've just asked. One is the future of central bank digital currencies, and the other is the reserve currency question, which is which currency will, eventually be the dominant reserve currency of the world. I don't even think that second question is a valid question to ask, because the nature of reserve currencies, I'll come to that in a second. But in terms of central bank digital currencies, I've now visited the live central bank digital currency sites, like in the Bahamas. I've been to El Salvador and had a look at their crypto initiative and stuff, and I'll be going to St. Kitts and Uruguay. It's funny because Uruguay experimented with central bank digital currencies, one of the first to experiment. They called it a success, and then they went quiet after that. And this was like in 2014 or something. And I was looking for white papers that talked about what Uruguay actually learned. And there's nothing available. So I'll be going there next month to have a conversation with regulators there. Now, what's interesting is that, let me just cut to the chase. And I say that central bank digital currencies we are destined to fail. And I'm probably the only person saying this at the moment with clarity, because of a number of reasons. The first reason is actually not even the intent of the central banks around the world. It's the fact that CBDCs will find it very difficult to keep up with the technology advances being made in crypto, in stablecoins, and so on. And the whole token industry, and the applications being created around them. In fact, if you look at all the so-called pilots that are taking place in France, in Canada, in Singapore, and then every initiative that they announce is always trying to keep up with the development that's already taken place in the crypto space. And if you look at any one crypto, take Solana, or one of these, just name anyone, they have like, 300,000, application developers working around them. And the amount of capital that they're able to raise, is astounding. And no central bank is putting in that amount of capital to create the technology required to make the central bank digital currencies robust. That's the first reason. The second reason is really that the idea of the central bank digital currencies, they've actually created a payment system that now stands parallel to their traditional banking system. And if you look at all the literature, it is all about central banks trying to justify why they need to run the central bank digital currencies through their traditional banking system anyway, so that they don't lose the fiat effect of of being able to leverage the economy and create debt and so on. And then there are other reasons. Like I went to to one of the islands nearby, and I asked the central bank governor. I said, you're one of the first countries in the world to issue a central bank digital currency. How's it going? He said, less than 1% uptake. That's because the banks just won't allow us to make the transition into CBDCs, and so on. So I think that the effort required to make the transition, many central banks are not, taking into account what's involved in terms of marketing, in terms of regulation, and the battle sometimes is at the point of sale. And even now with the transition from cash to digital, not many countries are making that transition very well at the point of sale, where the merchants require you to pay. What do you want to be able to pay with? So until we see some of these practical questions being answered, I don't see CBDCs, taking off in a real way. And then on top of that, you have this big issue of trust in government. Countries like Canada, after the truckers' riots, a couple of years ago now, nobody in the country trusts the regulator to issue a currency where they can switch off the tap on you, at will. So the fact that the US is also thinking about it makes me think that the Federal Reserve Bank hasn't taken into consideration public opinion yet. And once they do that, and once you see the debates in Congress, you'll start seeing a very different picture that, in terms of what will emerge. Now, what seems to be happening is that stable coins appear to be a more viable option than central bank digital currencies, because they, especially when they're regulated, they enable any bank to issue their own stable coins, populated, disseminated. There's a greater ownership at the operational level of the banking system. Okay, and so now then we come to the question of reserve currency. So in my book, I actually discussed this by going back to what actually happened that made the dollar a reserve currency. After World War II, after the Marshall Plan was full underway, the dollar was floating a lot outside of the U.S. The U.S. was finding it difficult to keep the tag to the price of gold and all that, right? And all of the other countries in the world found that the dollar was a cheaper source of funding. It was far more liquid, and many countries around the world were trying to build a trading capability, and the dollar offered itself as the currency of convenience that was liquid enough. And then the U.S. had laws put in place that this allowed the dollar from coming back into the country. And so today, 70% of the dollar in circulation circulates outside the US, right? So it was never an intention of any legislator in the US to make the US currency the de facto, global currency in that way. And because so much of it floats outside the US, no one trader is able to short the dollar or affect the dollar. I mean, it's just created that amount of liquidity, outside of the US. So what I'm actually suggesting is that currencies become global not through the intention of regulators. They become global because of a series of unintended consequences. And any country that wants to take over that functionality needs to ask itself, does it care enough about its own currency, or is it controlling its own currency too much that it will not allow it to be traded globally? So when we look at the renminbi, for example, there's no current capital account convertibility outside of China. In fact, the renminbi costs cheaper outside of China than in China because rates are kept higher in China to support the banking system, and the Chinese regulators themselves will not allow their own businesses to bring renminbi back into the country. And on top of that, the renminbi floating outside the current country, there's not enough liquidity. So when we think about the Belt and Road program, for example, just about every Chinese contractor outside of China wants to be paid in dollars. And I've had central bank regulators, governors sitting in front of me telling me that, China gave us $30 billion in swap agreement. We can't use it because all the Chinese contractors want to be paid in dollars. So until we start seeing a transition where a country doesn't care about how much of its own currency floats outside the country, then we start seeing a shift, dynamics in the shift of the role of the different currencies around the world. And on top of that, anyone who holds a dollar asset, say a treasury bill, technically the US is working for that investor, right? So any foreign central bank holding US treasury bills, it's the US working to provide the return on those bills. So for me, I'm just thinking, why would any country, except for reasons of prestige, want to have that responsibility? There are countries with very good bonds being issued. China is one of them. The EU is another. To spread out its risk and get foreign investors into its capital markets. To the extent that they support the capital markets, that's good. But to the extent that it becomes a burden that a country has to bear, I think that's something that no other country in the world would want to take it on. So I've actually seen perspectives which are separate, different from all the arguments or all the discussions that you probably see on reserve currencies today, which tend to focus on the petrodollar and stuff like that. There are some actions, like right now, the BRICS countries are talking to each other, saying that can we start dealing with each other in a currency other than the dollar, and then they look at each other and say, whose currency, and how much, and who can provide the liquidity, who will take the responsibility for it. So that kind of thing. The world will evolve and respond to different challenges over time. Like right now, it's the Russian-Ukraine crisis and so on. But there are some underlying themes that play out quietly. So that's what my book focuses on, the underlying themes, and that's what I think a lot about.
Right. Okay. Yeah, that's super interesting, because you think of most stable coins, they're all benchmarked against the dollar anyway. So definitely all stable coins I can think of, or anyone going to do a stable coin, they're going to want to benchmark it against the dollar.
Well, there'll be the dollar benchmark ones, but today there are euro benchmark ones, there are Singapore dollar benchmark ones. Any country can have its private sector players, including banks, issue stable coins. Then the question is, when they say they've issued stable coins, is there enough regulation to make sure that when they say it's benchmark, that they have the reserves to pay out if it's a run on a stable coin? And the world is discovering that whole process right now. Because I think that there were different approaches in benchmarking stable coins. One is to actually have the reserves in the form of treasury bills, or in the form of corporate debt, or in the form of cash, or in the form of algorithms. And that one got thrown out the window with the lunar crisis. So with the lunar fallout, right? So the thing is that the private sector, and this is an interesting battle that people don't see today. It was Barney Frank. I was having dinner with him one evening, and he said, the only people who's having a conversation that the government is the problem are Ronald Reagan and Margaret Thatcher in an afterlife conversation. And I laughed, when I heard him say that, because what we're seeing is the forces of the state, pushing against the free economy, the forces of private enterprise, and both have an important role to play today, especially when we see after COVID. The state has to build infrastructure and care, social safety net and so on, and then you have the private enterprise, which is the best arbiter of information and capital. It allocates capital in the most efficient manner, and it's brutal. So I think that's the battlefield that we're seeing in the new world that is being shaped through capital and through innovations in finance and so on.
Yeah, I'll just bring that up there, but let's speak about the Luna stablecoin, because obviously, and we'll speak about Binance and FTX in a minute as well, just to get your thoughts on both of that, Emmanuel. But just for our viewers to understand, can you explain how the Luna stablecoin ended up having a run of it and sort of collapsing? Because no one thought that was going to happen until it happened with Luna.
Well, both Luna and this week with or rather last 2 weeks with
FTX,
FTT, sorry, is that it's bad actors. Now, so to go back to first principles, cryptos are not difficult to create. Okay, they're not like building a bridge across a river. It requires far fewer engineers. It's kids, and in the case of FTX, the players were all kids. They were less than 30 years old, and they've never run a company before. They did not have a board of directors. It was friends of friends. Playing kitchen, literally. I mean, if you went into the essence of Sam Bankman-Fried, SBF, and his friends running FTX and Alameda Capital, and the thing is that these are early days. And I think that what's happening, and actually it goes back to my book, which is we are in a journey towards the transitioning towards the personalization of finance. So when we discuss these, crypto fallouts, the first thing we need to start by coming to terms with is anyone can issue a crypto. You can, I can, anyone watching this can. You just Google, it's probably 6 or 7 steps. And you can issue a crypto of your own. And that's the beauty of the crypto industry, is that every one of us can build our own crypto, which means that then we have to figure out why we created a crypto, what is the value that we want to put into the crypto, and whether others will accept the crypto that we created. So this is the universe that's being created. And it's just that the early players are discovering that the markets will reward them incredibly for the cryptos that they've created, because of whatever reason the market wants to give itself. So in the case of FTX, there's some utilities around it. In the case of Luna, it can be switched to other cryptos in order to trade in decentralized finance. And these are actually quite lame excuses, by the way, because the technologies for the network world are just coming into shape. And the utilities that they create just one point different from the other crypto, their competitors, and so on. The fact that markets were willing to give them $8 billion, and so on, and then they leveraged it up to like $40 billion. They're playing with numbers that they've never seen in their lifetime. Then we have to ask ourselves, what in the world is the venture capital universe looking at? What is their raison d'etre? What is their reason for existence? What is their methodology in terms of valuing what's being created today? In fact, the platform era was a more stable universe where a venture capital will say your ability to onboard as many users as possible is the criteria by which we will value you. And then now for crypto, it's whoever becomes popular. That is, they have many buyers for their crypto, many users for their crypto, and so on. But that's so fleeting that it's very difficult to put a valuation on it. The more cryptos that are being created, the more stable that universe becomes. because then you'll find capital being allocated much more across the board, and it'll be closer to the utility of the capital. And I think that we are working ourselves, towards that. In fact, the fallout from FTX and Luna is good because the valuations go down, and then the capital gets spread out to any number of cryptos out there. Because the journey that we are on is the networked world where cryptos are created for utility, for functions. And in that world, there's no reason why a crypto should be overvalued, that it should have a functional value that's commensurate with the activity that it's supporting. So and I think we're getting there. We will get there eventually. So these fallouts are all very good, except that it's not going to reward anyone in the process.
Yeah. That's super interesting. So how does it? We'll bring in the next sort of topic. Moving on from there, is like sort of financial inclusion. So, you're speaking about this at sort of a high end from a banking perspective, but for people sitting at home, how do you see this new digital world including them financially? Are they going to be excluded, or how's it going to work for your average Joe, as they say in America? Not Joe Biden, obviously.
The first rule about financial inclusion is nobody in the world wants to be financially included. Nobody wants to have a mortgage. People want to have a house. Nobody wants to have an automobile loan. They want to have a car, a spanky car. So the aspiration of every person, rich or poor, is to be digitally included, not financially included. And when the World Bank puts out a report saying that 20% of the world is not financially included, what they mean is that 20% of the, and they come up with a number by saying that 20% of the world does not have bank accounts. Who needs a bank account today? I want digital access to the things I want to do, and today you have digital wallets, for example, that takes away the need to have bank accounts. Bank accounts are actually cruel, especially for poor people, because they don't pay a good interest rate. You're just leaving it in there. It's hard to take out that money unless you walk out to an ATM and so on. But if you in a digital wallet ecosystem, you can do just about everything in your life, the life's daily needs, out of a digital wallet. So banks need to think that way, and then of course they need to think that a stablecoin can be a digital wallet too. So we're getting that way, right? So the question that people who are trying to use the financial inclusion excuse, the question they're asking is different from the answer that's being developed right now, the reality that's becoming true in the world that we live in. And on top of that, when you think about fintechs or financial technology companies using the financial inclusion as an excuse for the reason of the existence, what are they saying? They're saying that we want to onboard as many poor people as possible onto our platforms and then monetize them. Right. So, and why? Because that's what the venture capitalist is asking you to do. And they're using the platform analogy, the platform model that existed in the 1990s into the 2000s. And that model is starting to disintegrate, according to my thinking and according to my book. So I think that so that's why I'm willing to say that the excuse that financial inclusion is a lie. It's created by venture capitalists to support the platform idea of the economy. What we really need to move into is not financial inclusion, but digital inclusion for all in society.
Mm-hmm. Yeah. That's a good perspective on how it actually works for people out there, because essentially after COVID, I've been explaining the world's going like that, splitting further and further, those who have and those who have nots, and a lot to do with the asset ownership. So how's this digital inclusion going to help people who are on this side of the line who don't own assets, and our parents don't own assets, so they're not going to inherit any sort of house or property from that as well? How do you think the world's going to be affected to them with what's happening, Emmanuel?
You know, the one of the cruel things that regulators or central banks and regulators are doing is to prohibit uh, the the poor people in their society from participating in the digital economy, and they prohibit them by simple things like not giving them easy access to cryptocurrencies, for example. And when they do that, they're making a judgment call that poor people are not entitled to make an educated guess as to where wealth is going to be created in the future. And I think that that's a wrong approach. In fact, the people you need to exclude or control their access to alternative capital or alternative investments are the middle class. In fact, like I saw a piece of research that said from January to September this year, nearly $2 trillion was wiped up from 401k accounts in the US, right? So, and that is much more troubling than not allowing people who don't have money anyway from, trying to dabble with digital assets and the things that they want to learn from. In fact, one of the interesting stories was a poor kid in India, had been collecting Bitcoin for, about 10 years or so, and he became the biggest buyer of an NFT, $64 million from Beeple, right? And he still believes only in cryptocurrencies. He doesn't own a house and stuff like that. And people who don't have assets can make those judgment calls because they don't have liabilities either. They don't have something hanging around on their back. So the first thing I'll say there is that central banks or regulators should stop trying to guess what assets are dangerous and what are not, what assets are not. And the second thing there is that giving digital access to all manner of assets, including NFTs, is now actually almost a human right. It's putting everybody on the same starting line. Then how these assets will perform is an interesting journey that is already taking shape. And where it's leading to is very interesting. And I say this in the last chapter of my book, which is that we are transforming from an asset-heavy economy to an asset-light economy, where through sharing and through networking, that many of the next generation, the Gen Z and beyond, are not as interested in owning an asset as they are in utilizing an asset and sharing an asset. And we are moving into that dimension. And it's something that those of us who are baby boomers will never understand. And already we are seeing this on the balance sheets of large corporations. They're becoming asset light. They're offloading buildings, they're offloading, anything that's a form of asset and focusing on their core business and having a huge trading book instead. Any of the large corporations which are cash heavy today, they have a trading book which is as large as their actual core business. So we are actually moving into an asset-light universe without realizing it. And it's just that in order to function in that universe, you need to be digitally accessible.
Right. Okay. Yeah. No, that makes sense there as well. Let me bring it. Normally we bring in like a couple of additional articles that are out there that are topical during the week. So, I'll bring this one in that I was reading earlier because I was obviously wanting to speak about the stable coins. But this is JP Morgan. I don't know if you can see that, Emmanuel. They're saying the shrinking stable coin market is another sign of investors' exodus from crypto. So people are now talking about this crypto winter coming in, and this is basically this article has been driven on CoinDesk to do with the markets. So where do you see this happening? This is from JP Morgan, and obviously, they were one of the early adopters of crypto from a major bank. So where do you see this happening, and do you see a crypto winter coming, or what do you think? is going to be happening with this?
Again, in my book, I actually outline the phases in which civilization evolves from one phase to the next, and I actually borrow that idea from someone I totally respect, who said that society moves from its tribal to its institutional to its markets and then to its network phases. When you see a comment like this, you need to ask which dimension are they thinking on. So if you look at the value of crypto today and treat it as a securities asset, you fall into the markets dimension strictly. So everything that Charlie Munger and all this old time really strong equities investors say are true, are correct. You have to buy that in, okay? And the rules of the market applies. So everything that's happening in the crypto winter is a function of the market, and it's the same winter that's affecting equities winter. It's the same winter that's affecting the bonds market winter, and gold markets and everything else. So it's an investment, universe. But there is the next dimension, which is the network universe, which is still being created. It's the utility of these digital assets that we need to look at. We need to look at open source computing. We need to look at APIs on the blockchain. We need to look at network of networks. That's where the value of all of these technologies being created will become a reality and become a daily reality in our lives. And it will dictate entire economies. And the dimension that these network utilities are creating will create a GDP effect that's already being absorbed into how GDP is being calculated in countries like the US right now. So it's not inconceivable that the GDP of the US can go from 20 billion, which is where it is about right now, to 40 billion, just absorbing all of the value being created in the network effect, and that universe is not here yet, and it's nothing to do with the crypto winter that we see today, So we need to pay attention to where we are and what it is that we're discussing, and then adhere to the truisms that operate in that ecosystem. So crypto as an asset, as a security, it falls into the same rules as any other security. Crypto as a token for the network effect, that's a totally different universe that is still being created.
Mm-hmm. Yeah, that's a good perspective to explain it like that. And we were speaking about Binance and FTX and earlier.
JP Morgan plays both sides quite well, by the way. Is issuing its own coins, is working with companies like Pator, building the network effect, while saying that, and it's probably, in my view, probably going to be one of the first banks to issue its own stablecoin when they get the rules in place. Okay, while it's issuing reports like this.
Yeah, exactly. Well, they're the ones leading the field anyway in terms of all the white papers and technology. But coming back to Binance and FTX, so this is Binance's CEO basically saying we were the last straw that broke the camel's back. And obviously now he's coming out and having to make multiple statements. But can you explain to people how Binance was involved in FTX and why Binance is going to be secure going forward when someone like FTX has just gone down?
Well, I think CZ is really worried that that this fallout is not even a crypto winter story. It's the knock-on effect. The chain reaction of one crypto affecting everything else. It's also a story of two crypto giants screwing each other, if you pardon the expression. It was CZ that bought the most number of FTTs, the tokens that FTX had created, and he had held on to about 70% of the tokens, and so he was holding on to it. And then when he realized that that the valuation of the tokens could not be sustained by the assets that the FTX had, he did what was the right thing, which is to offload as quickly as possible while the value was still there. And as he did that, the valuation just dropped and then affected Alameda and then had a knock-on effect back to FTX. So and it was. It looked like he was screwing, Sam Bankman-Fried, SBF, but he had actually took on the FTT tokens as a matter of trust because to support SBF to build his business and so on, and then there were other stories such as SBF had gone out to the Congress and started promoting the idea of regulating exchanges, just like traditional exchanges and so on, which the rest of the industry did not like and would have made it very difficult for the rest of the industry to keep growing. So I think that there was a loss of trust between these two friends or frenemies. They were competitors at the same time. They were holding each other's assets on their books, and yes, it will affect Binance going forward. And Binance's own token, and it's affecting everybody else as well. But then at some point the rout will stop, and then we'll see what's left on the table. And what's left on the table has enough technology in it to grow again and to build in the disciplines, not to have algorithms that don't work, and to be more transparent to customers. And customers themselves or users themselves will be far more critical about the exchanges that they operate on. In fact, there's now a move towards users managing their own assets, digital assets, taking it off the exchanges, taking it off open wallets and creating your own wallets and so on. So that in itself has a disciplining effect on the industry, and I think it will evolve. The question now is whether the institutional players will be regulated but will be properly regulated, and then create a different universe than what was intended or where it was going, which is that it's not a free for all. You need to first get a license before you even issue a token. If that happens, then we'll see a very different universe than the personalization of finance. And I don't see that universe coming about.
Yeah. So how does Binance actually operate with the Chinese government? Or how does it work with that? You're based out in China, so you could give a bit of an insight to this because everyone wants to know.
Well, firstly, I was surprised that many of the exchange operators around the world and token holders are Chinese today, and they've been internationalized precisely because the Chinese government shut down on crypto in China. In fact, a lot of the blockchain projects in China are finding it difficult to build a full working model because they're not allowed to issue cryptos. And I think that China is doing itself a disservice by banning cryptos in that way. But outside of China, many of the actors are Chinese. From the ones that I've met, I've not yet met CZ, but I've met people who do business with him. Firstly, I think he's Canadian now. I think he's changed his passport, so he's not Chinese national in that way. And I think they now stand as a counterbalance against what China is doing as a country. So I think we need to see that as the operating principle for now. Will they go back and support some nefarious initiative for Chinese government? I don't think so. I think we should treat Binance as an international play, because even China would not want to have anything to do with the universe that Binance has created. It's a very robust universe, and it's a issue of tokens by itself, and it's got a network effect outside of China that China doesn't want to see come back into China right now. Now, would they make deals for data to be processed in China? There might be deals like that, but if there were, I think that Binance will collapse if the international market discovers that there's any collusion with the Chinese government.
And then, we were talking the other week about Hong Kong, and then, they've just published like 3/4 of negative growth in Hong Kong. So, unlike America, when they publish negative growth in Hong Kong, it is a recession. It's just not a recession over here, according to the White House. How will Hong Kong play with that in terms of, because now they're wanting to maybe, be more open. I know there's some security token exchanges out there as well, ATSs for alternative trading now starting to operate there. How will Hong Kong get to operate going forward, do you think?
I think for now, there is a lot more, initiatives in Hong Kong to make it fall in line with the overall Chinese government's direction in crypto and in alternative platforms. So I think Hong Kong will not be as robust as Singapore is right now. And I know the regulators in Singapore, I know some of the key influencers in the whole ecosystem. They are amazing. They want to regulate cryptos, but at the same time, they see the value of stablecoin, the applications that can be developed around the token and all that. Hong Kong sees that too, but its hands will be a little tight because the Hong Kong Monetary Authority will need to fall in line with the Chinese government, PBOC and the CBIRC in China, and so I think that you won't see Hong Kong allowing too many experiments or initiatives or even exchanges being built, which makes it look like China has lost out or something's happening in Hong Kong that China should be doing too. In fact, China is having a hard time, curbing the exchange activities of its own people, that it just would not allow something like that to happen in Hong Kong. So I think that Singapore is more of a of the region, of the country, or of the jurisdiction that will be more liberal than Hong Kong will be in that part of the world, and everybody else. So I maybe Korea and Japan. These are the other two that are far more progressive than China is at the moment.
Okay, yeah, that's interesting. So we'll just bring it up because that's just getting over 45 minutes just now, Emmanuel, and I appreciate you're a busy guy. But what we'll do is we'll bring in your book just now, just to give a bit the great transition. If you want to finish off and give a little bit more about where people can actually purchase this, and we'll definitely provide a link below. And then what's the future for yourself?
Right. So it's available on. All the details are available on my blog page. So that's emmanueldaniel.com. If you go in there, you'll see it right away. And you'll see the table of contents. Interesting thing about my book is I start the first two chapters by working out the first principles of the future of finance. What do we mean by token? How do we capture value? Questions like that. How will the network world look like going into the future? Then in the middle of the book, I sort of go back into the first principles of banking, and there I'm struggling with what banks think of themselves and what actually worked in banking originally that is now transitioning into the digital space. So, for example, one of the things I say very clearly is that the essence of banking is the balance sheet, not the technology. And we're seeing that right now. Okay, that when the tide goes down, you see who's naked, which is when all the easy money goes down, you see what actually works in banking. And in banking, the risk that you take on at what price is what you will end up paying for, and if you can't afford it, your business will go bust. And then I challenge the banking industry to say, something, you really need to think about your products in banking today. The deposit account is no longer a tenable product in the same way that the 35mm film was no longer a tenable product when the digital camera came about. And yet Kodak, went into bankruptcy 15 years after originating digital films. Okay, that kind of thinking. And then I end the book by looking at mapping out how the transition will evolve. And I really hope that people enjoy reading this book, not for cliches and current things that are happening, but underlining principles that you can apply as you see the transitions taking place. So that is why, as I see the crypto winter and the fallout with FTX and Luna and so on, I still see the trend evolving. Because I go back to first principles and I see what people do on the ground, which is the API developers are still working on it. Capital is still being formed on tokens, and the network effect is coming into place through things like gaming, NFTs, and so on. NFTs may evolve to become more mature in that it will not just be about pecuniary things that we collect, but more valuable stuff. The whole idea of what value is being translated into the network world. And so for the thinking person, this book sort of goes back into giving you the roadmap by which you can figure out your own future. In fact, after writing this book, I'm learning and I'm coming up with ideas that are more current as we go along.
Yeah, my dad was a traditional banker, 30 years with the manager of Bank of Scotland, which was one of the first banks back in the UK, back in the 1600s, believe it or not. So maybe I should just get this for his Christmas present this year. You know, he doesn't listen to my podcast anyway, so that could be a good one because he's always interested to know what's going there. He's come from traditional banking, you know.
Even there's something very interesting. You know, the original bankers of the world were the Scotsmen, right?
Yeah.
Because there was this trusted element that was within the community, and and HSBC, was essentially a Scotsman-built institution and a global institution on that. So there's
the Royal Bank of Scotland still there. You know, the name's still going.
So in the last chapter of my book, when I say we transition from tribal to institutional to markets to networks, banking was tribal. That if you were a Scotsman working in close connect with other Scotsmen, you can actually build a global business, and you can institutionalize it, that sort of thing. So you can actually tell stories around, and your father will probably agree with me that there was a time when the trust and the integrity and the hard work of the Scotsmen build some of the best banks we know today.
Yeah, exactly. And then the 2008 banking boom came along, and then they let the salesmen start selling debt to each other, and it was finished on that note as well. Just because we were speaking about that, when that banking crisis happened, do you think that banking crisis will ever happen again?
Oh, I'm saying it will again and again and again. Oh. And why? So I take the reader in my book through a journey and say that, when you look at the banking crisis of 1984, it was based on actual mortgages. Okay, it was the savings and loans crisis. The mom and pop banks could not match their assets and liabilities, where the underlying asset was an actual mortgage, a house owned by their customers. And then by the time you reach the 1990, any crisis after that, 1997 Asian crisis, it was more economies and so on. And then, when you look at Enron and then you look at the 2008 crisis, the world was moving towards the underlying assets becoming increasingly ephemeral. In other words, they were no longer the underlying assets. It was a derivative on the asset, and then a derivative, a security on the asset, and then a derivative on the security, and then a derivative on the derivative, right? So I'm saying this in my book that we are moving into the financialization of everything. Not just mortgages, but any asset that is tangible today is being financialized. And so the next financial crisis will be a highly financialized crisis, far more than the 2008 crisis.
No. Yeah, it makes sense the way you've explained it, though. For a lot of people, especially coming from that banking world, they just can't understand it because it was all to do with, as you say, traditional banking, safe lending. This is the business plan, what I'm coming in for, why I'm loan money, where's the assets against it. And now, as you say, it's just moved up so many different levels that, that type of banking and it's the technology, as you say, Emmanuel. It's just, until we were all interconnected, that was it. You had to go in, knock on the door, set up your appointment. Here's my business plan, read the plan. I'll lend against that, are you a high risk bank manager or a low risk bank manager? And that was the way. And then suddenly the internet basically started this. And I just feel like the blockchain's just it's the next iteration of the internet, when it's the finance of the internet, basically. And everything you speak about's, covering that.
Yeah, and in my book, I have a special section on the LIBOR crisis, right? Where it was a crisis that the media predicated as a crisis of morality, that is, bankers doing what they shouldn't be doing. But actually, I called it a crisis in transition, which is you had the rate setters who existed in the markets phase, in the institutional phase of the industry, and you had the traders who were in the markets phase, and the traders looking for any index that they could trade on, and poring over the rate setters to say, hey, can you tweak your rates in order to help us with the markets. It was two sets of players doing the best in their respective fields. And so as we make other transitions, like from markets to networks, we will find other forms of anomalies or bad behavior that is not morally bad. It's just that one player did not understand, the operations of the another player. So someone in the network world looking at someone in the markets world will have certain requirements from the securities being traded, which the markets world just doesn't do, today. So every transition, and the person I referred to, who wrote this paper where society moves from tribal to institutional to markets to networks, he said that the crime in the network world is deception. Where every one of the players have exactly the same information that they have of each other. In other words, there's no asymmetry of information, but then the crime is the intention behind the use of the information. So go figure out, what the
That's a perfect way to finish the show today, Emmanuel. We could sit and talk about this stuff all day long, so it's just super interesting. So, well, thanks very much for coming on to the show. We've got the websites, emmanueldaniel.com. We'll have all the information on where you can acquire his book in the show notes below. Appreciate you're a really busy guy. It'll be great to get you on the show in the future again, Emmanuel. So, but yeah, thanks very much for coming on the show today.
Much for the privilege.
Okay. Thanks to everyone out there. You've been watching Boom It's on the Blockchain. My name's Alistair Caithness. Have a nice day.